And we are live. Hello to our freedom-loving friends, followers of the Libertarian Party. I am Connor Nepomuceno. I am your social media committee advisor, as well as manager of the Facebook page, elected Region 3 alternate. I'm joined by Mike Termat to talk about the origins of the Federal Reserve System and to talk about the problems with it and some libertarian solutions. So welcome, Mike.
Thank you. Good to see you, Connor. Great to have met you in Michigan in person finally for the first time a couple weeks ago at the convention. And no, I was not offended that you approached me because surely this guy is old enough to remember the creation of the Fed. I'm sure that's not exactly what you meant.
No, but let's talk about your experience and your qualifications before we really get into the meat and potatoes here. Why are you qualified to talk about this subject?
The one thing more boring than talking about the Fed is talking about me and my background. I can assure you of that. I was a professional economist for probably 20 years before becoming a police officer. I worked for a couple of banks in the 80s. When I got out of business school in commercial banking, and then went back to grad school, studied economics, earned graduate degrees from the George Washington University, which is what we used to call, and some places still call, the Rational Expectations School, which is sort of a descendant of the Chicago School of Thought, which of course is an offspring of Austrian school thinking. So I was very lucky and indeed privileged to be able to go to such a place and studied, the full panoply, right? Microeconomics and macroeconomics. My specialty was finance and international economics, but went to work for the federal government after that, a couple agencies, international agencies. I worked for the White House for a couple of years. Went to work as a free market advocate of sorts for the American Bankers Association. I worked for them as an economist for a bunch of years. And then a buddy of mine and I had our own business educating bankers for a long time. I also, along the way, taught economics not only at George Washington, where I was in school. It's how I paid my way through school, of course, like so many youngsters do. But I had the opportunity to teach at Nova, Southeastern University in Florida, and at Barry University in Miami. Terrific experiences. And so I guess in that sense, I've been around the block. I've done some research on the banking industry that had been referenced by the Fed. I've met with the Fed board in their austere boardroom itself. It can be a bit of an intimidating place, even if on some level you might think it's a clown show. But once you're actually in the room, I can assure you that they do their best at being as intimidating as possible.
So before we dive, I have one question. You were a consultant for the Obama administration, weren't you?
No, although I'm sure that would have been fun. I worked as a civil servant economist, not as a political appointee.
Gotcha.
In the George Herbert Walker Bush administration. That's going way back.
Okay.
W's dad, in the days when he said, "Read my lips, no new taxes," and then of course went back on that pledge, and it was like, oh my God, what are we dealing with? So, yeah, I've had my share of political disappointments.
All right, so let's get into the subject matter then. So what can you tell us about the history preceding the creation of the Federal Reserve? Like what was the situation in America that prompted the creation of this system?
Well, we did have a series of sort of panics and bank runs before people had instituted the Federal Reserve. The idea of a central bank is something that had been kicked around for a century, of course. And now when we look back, all modern economies have some sort of central bank. But in those days, such was not the case. But we had plenty of people who argued about the matter for the entirety of American history, from the Declaration of Independence through the creation of the Fed in 1913. There was never a moment when it wasn't argued about. And the basic idea was surely our currency, such as it was, and we can talk about all the various things that meant in those days, played a role in the panics and bank runs that we had periodically, some of which were quite profound and quite deep and quite disturbing on an economic level. Certainly, as much as we're frustrated by the Fed today, you can certainly understand the motivation of people in those days grasping for what can we do to smooth out economic behavior, the topsy-turvy nature of things. And there were good periods. We could put together a couple of decades of steady growth. And of course, in those days, it was hard to measure. So it's very hard to evaluate looking back.
Yeah.
But some of the periods that we went through of depression were quite significant. So people remember in those days, currency was issued by the banks. It was not standardized. Then we went through a period during which it was standardized, but still issued by the banks, which is an interesting period. Before the Fed took over complete control of monetary policy, national banks were issuing a standardized currency. So the idea was that surely there's a way to control the money that was in the United States. And in doing so, by doing so, we would be able to prevent some of the runs on banks that were quite significant, as well as the depressions that economists believed in those days were a direct result of the runs on banks, sort of a chicken and egg problem that we argue about to this day.
Now, can I jump in there? Now,
please.
Some of the recessions of that era, during the free banking era, that's what it's kind of called, right? Following Reconstruction up to
including wildcat banking. That's right.
So a lot of those recessions, yes, they were severe, but how would you say they stack up to some of the recessions we've had under the regime of central banking? It's my understanding that recessions were, while highly localized and devastating in their own way, they didn't have the same long-term protracted consequences like, for example, the Great Depression or the Great Recession have had.
Yeah, I think that's exactly right. And this is something that we can argue about because we don't have terrific data that's regional going back. The best data that we have is on bank runs themselves and anecdotal evidence of how bad the recessions were. But our best guess is that you're exactly right. They were quite significant, but weren't as bad as the Depression. And of course, the irony, which we'll get to in a moment, is that the central bank, we now believe, contributed to the depth to which the economy plummeted during the Great Depression in the 20s and 30s. So, best intentions notwithstanding, I have some sympathy for the folks in those days who were, like I say, grasping at straws. But the creation of a central bank didn't turn out to be the silver bullet that we had all hoped. So, and by we, I mean we as a nation. I wasn't actually there in the 1900s to argue about it.
Okay, so moving on to the next question. Can you describe what the actual function and structure of the Federal Reserve System is?
Sure. When we talk about the Federal Reserve System, we mean the regional banks themselves, the Federal Reserve banks. There are a dozen of them, and the Federal Open Market Committee and the controlling structure of the Federal Reserve System. So it's all of a part. The 12 reserve banks are located in areas where in those days the biggest commercial banks were located, and they were set up to serve the function of keeping the commercial banks' reserves. That's why the whole system is called the Federal Reserve System, of course. And these are the Federal Reserve banks. And the idea was that if we required the commercial banks to keep in reserve a fraction of the deposits they took, then we would always be assured that the commercial banking system would have liquidity and that we'd be able to mitigate against this idea of substantial bank runs. So that's why you've got these Federal Reserve banks, the local institutions that are part of the Federal Reserve system, set up in places where in those days they were what were expected to continue to be. Nowadays, it looks kind of funny when you look at the list of the 12 cities. But in those days is what we expected to be the big money centers. So, it makes sense. You wouldn't be surprised. Boston, New York, Philadelphia, right? Atlanta, which is a great guess. I don't know that they knew in those days that Atlanta was going to explode into, what is it now, the fourth largest city in the United States. But Richmond is another one, which maybe wasn't as good a bet as Atlanta was. Then you got Cleveland, St. Louis, Kansas City, Chicago, Minneapolis, San Francisco, Dallas. I hope I've named all 12. If not, apologies to whoever I forgot.
There isn't one on the West Coast?
San Francisco.
Oh, okay.
Yeah. And Dallas, which in those days was considered quite far west, right?
Yes, getting towards the frontier.
Yeah, if you were going to set them up today, I'm sure you wouldn't leave out Seattle and Los Angeles and maybe something even in Vegas. So the idea is that those institutions are set up to provide services to the commercial banking system, but also to require the commercial banking system to keep deposits at the Federal Reserve banks, reserves against the commercial deposits that they take. And that was the idea was that would be a requirement. And by requiring those reserves, the central banking system would be able to preclude bank runs going forward.
Gotcha. So you mentioned very specifically it's a fractional system. Can you expand upon that? So for all the money that we have, there's no actual amount of assets that equals the money that's circulated, correct?
Right. When you, as you probably know, when you deposit $100 in the bank, it's no longer there, right? It gets lent out. So imagine, and this is, of course, how we want the system to work. We make a deposit in the bank takes that money, presumably lends it out and makes a profit off of it. Imagine in those days with no rules in place and the technologies of keeping track of liabilities and assets weren't that good across the industry. So it'd be hard to know how the industry was doing, much less an individual institution from the outside. Certainly from the outside, bank managers knew how things were going, but from the outside, it was difficult to tell. So imagine an institution takes your deposit and lends it out. Well, why not just keep doing that as rapidly as possible? You would feel the necessity to keep virtually nothing in reserves. All you really had to worry about was someone coming in, taking out $100. I can meet that easy. If everybody comes in at the same time and wants their money, now I've got a problem, which of course is why bank runs are often referred to as panics, because it's the psychology that makes things go wrong, right? When people think a bank is in trouble, then it is in trouble. Because when people are nervous that if they don't get there first and get their money out, then that's when they want to be first and get their money out so that they can, because they know darn well that the bank doesn't have everything in reserve. So when it was first initiated, there were reserve requirements that were quite substantial. In the beginning, over 20% for certain types of accounts. So you could only lend out, say, if the reserve requirement were 20%, you could only lend out 80% of the deposit you took in. And this would slow down the creation of money. So think about it. If we define money as all the assets that you think you have, whether you have it in your pocket or not, right? Mm-hmm. Because let's be fair. If you have a deposit at the bank, you kind of feel like you have that amount of money, right? Yes. I mean, certainly I feel like I've got the $800 that's in my checking account. I know on some analytic level, it's not really there, but I make decisions as though it were because I have access to it. Well, I deposit my money at the bank. It gets lent out, which means someone else now has it. They put it in their bank. Their bank keeps a reserve, a fractional reserve against that, lends out the rest, and so on and so on and so on. So you can see that the amount of money that gets created by my initial deposit is quite substantial. It's some multiple of the initial deposit. So the idea is if you can control the fraction that is held in reserve, you can make a large impact on the total amount of money in the system.
Yes. So the normal rate for the reserve rate is typically 10%, isn't it?
Not anymore.
I know not anymore, but if we look at even up to just a couple of years ago, it was for a long time.
And it depends on what we mean by the rate. Let's break it down. Nowadays, the reserve requirement has actually gone to zero.
Yes.
Because the Federal Reserve System has learned, I think we would all argue, learned the hard way, that you don't need reserves in the system to maintain liquidity. Indeed, the creation of the Federal Reserve System itself provides liquidity in a pinch. We can argue about whether it's a good idea or not a good idea. We'll get back to bank bailouts, I'm sure, before we close tonight. Mm-hmm. But in a pinch, if the Federal Reserve System is there to make loans to banks when they need more liquidity than the reserves they have on hand, then why do they need reserves at all? So the Fed requires banks to keep reserves so they can control the creation of money. That's the reason that they do it. So nowadays, the reserve requirement as of March 2020, I want to say, I can remember 1913 a lot better than I can remember 2020, Connor. So you have to forgive me for that. But I believe it's been since March of 2020. The reserve requirement has actually gone to zero on small deposits like mine.
I don't remember when, but I believe towards the end of the Great Recession, they brought the reserve requirement back, because I remember I think it was either late 2019 or just after the pandemic really hit in early 2020. I remember they announced that they had suspended the reserve requirement again. So we had a 10-year period from the end of the Great Recession to the start of 2020 when we had a reserve requirement again. And I mean, you could also argue that the money system was a little more stable in that time period, wouldn't you think?
You can argue that, and we'll get to that in a moment.
Yes.
We don't actually require the commercial banks. Our government doesn't require commercial banks to keep reserves now. They naturally do, because they have to keep something in order to settle transactions among themselves, as well as transactions with their banking customers. So if you define reserves as money you have on hand inside the bank itself, as well as what's on deposit at your local Federal Reserve Bank, those have to be non-zero just for transactional purposes, just for the business of the bank. So the Federal Reserve no longer requires anything above that. Now, let's talk about the market for that.
Yes.
There is a market that's been going on for the past 100 years, whereby which banks trade among each other, trade among themselves, these reserves. I need to keep a certain amount of reserve at the Federal Reserve Bank. You need to keep a certain amount of money at the Federal Reserve Bank. On Tuesday, I got more than I need. But on Tuesday, you got less than you need. So you need to borrow some from me. So banks are always making these relatively small compared to the size of the bank, but they can be certainly multi-billion-dollar transactions. Banks are always trading among themselves the reserves that they need to keep on hand. And we call that interest rate that they charge each other for these short-term transactions the federal funds rate, because it is funds available at the Fed that they're trading back and forth. And it is that rate that the Fed targets. It doesn't control directly. The banks make the market in this, but the Fed influences that rate, and it's that rate that the Fed focuses on so much as its primary instrument for controlling monetary policy.
So when they say we're taking interest rates either lower or higher, they're setting the target at different points.
That's right.
So what are the actual mechanisms that control that rate?
Allowing for a large portion of that to be psychology, the idea is that they will conduct what they refer to as open market operations. Mm-hmm. They get so used to saying open market operations, they actually abbreviate it OMOs. Okay. The Federal Reserve System, the Federal Reserve Board decides, actually, technically, the Federal Open Market Committee. We can talk about who that is. That's, for the most part, the Federal Reserve Board, the chairman and the other 6 members of the Federal Reserve Board, plus some of the presidents of the Federal Reserve banks. That committee, the Federal Open Market Committee, decides what they want the federal funds rate to be, or at least targets it. We would like the Fed funds rate to be 1.75 this month instead of 1% like it was a couple of months ago. And they're meeting again today and tomorrow to raise it again. So they'll probably increase their target from 1.75 to probably 2.5%. So what they'll do, in answer to your question, how do they get the rate to go up? Because they can't just decide it by fiat. They affect it by policy. They'll conduct open market operations to take securities out of the system or put securities into the system in exchange for money, knowing that that money will go to the banks and then go into the reserve market. So imagine, that was sort of a mouthful. Imagine if you wanted the Fed funds rate to, let's say, to go up, right? We want it to go from 175 to 250, probably tomorrow, probably the day after tomorrow is when they're going to start trying to make the market tighter. And what that means is that they want a tighter monetary policy because of all the inflation that we have going on lately. Mm-hmm. Of course, which is their own damn fault, but yes. Let's abstract away from blame here for the moment. We're trying to be polite. They want the Fed funds rate to go from 175 to 250 basis points in a couple of days. So that means that they want the market to be tighter. So they'll have to take reserves out of the market. Okay. How do you take reserves out of the market? They'll have to put securities into the market in exchange for cash. The Fed has a ginormous balance sheet consisting mostly of Treasury securities, but also the bonds of a variety of agencies. But let's stick with Treasury bonds and notes at the moment, bonds and bills at the moment. They'll lay out several $billion more than usual. They'll lay out several $1 billion worth of Treasury securities on the open market. The Federal Reserve Bank of New York conducts these transactions for them, makes them available to primary securities dealers in New York City, mm-hmm. who will pay for them by giving the Fed money. And that money thereby comes out of the system.
So you're effectively talking about ledger money, aren't you?
Yes.
Taking the money that doesn't necessarily actually exist. Like, we're not talking about big stacks of cash here. We're talking We're talking about numbers in books.
That's right. And to your point, not to sharpen the pencil too much, but not even books. Right?
Yes.
These are bits, ergs, and decibels on a computer. So yes, to your point, it's not actually paper cash, but it is what we would call money, and it is the stuff that changes prices around the world. So it is stuff that matters.
Yes. So I have a couple questions from this line of questioning. So when we're talking about the Fed's balance sheet, that is in reference to the actual assets that they have, correct?
Correct. And so liabilities. So they carry as assets all these treasury securities that they've been buying since the earth cooled in 1913, but has been a relatively modest number by comparison until the last few years. Now that balance sheet is $9 trillion, something like this. I probably should have checked this morning because it changes fairly rapidly. Sometimes it's gone up by, probably $1 trillion in the last probably 18 months. Going back maybe a half a dozen years ago, it was on the order of 14 trillion. We've really been adding some of those years adding a lot more than $1 trillion to the Fed balance sheet. Think about what that means. They are buying securities at a very fast pace in order to put money out there. So they're buying treasury securities, putting money in the hands of the primary securities dealers who deposit them into the commercial bank accounts. And that's where the reserves, the excess reserves come from that go into the Fed funds market and lowers the interest rate.
Gotcha. So these
all of which was necessitated, of course, because they, in effect, lost control of the Fed funds market when they drove the interest rate all the way down to zero in the Great Recession.
Yes. And we've hovered right around that zero for the 10 years since. I know we talked about earlier briefly having the reserve rate at 10%, but with the interest rate still at zero, there's still a tremendous amount of money just flying around rapidly, isn't there?
A tremendous amount of money. Yeah. In the Great Recession, I say we, I don't know why I say we, I still think that, we're all in this together, right? We're all Americans. It's like when we go to war, we use this pronoun we, even though, you and I neither think it's a good idea, nor are we over there fighting, but we still say we, right?
No. You or I certainly didn't lend out these trillions of dollars, just like you or I are not shooting at some foreigners.
Yeah, that's exactly right. So let's be careful about how we use the word we.
Absolutely.
But we're our central bank on our behalf.
Yes.
Right.
For the audience, we, the United States, as a whole, a collective, unfortunately,
put out so much money, bought so many treasury securities that they drove the Fed funds rate all the way down to zero. And yes, to your point, kept it there for many years during the Great Recession. It came up. I don't remember what it peaked at, 2%, 2.5%, like something like that, just a few years ago. And then when COVID hit, it got driven all the way back down to zero again. So think about what that means. If you're targeting an interest rate of zero, and you want there to be even more money out there, it's a tricky situation. Now, you could try to, experiment with what the world would be like with a negative interest rate environment, but that's a little weird and presents some of its own problems. So that's how we got into, what became known as quantitative easing, which is to say, we're not going to be targeting a different Fed funds rate from time to time. We're going to be targeting an amount of securities that we're going to go in and purchase on a monthly basis, quarterly basis, and experiment with what that does to money creation.
Yes. So let's rewind a little bit to 2018. And I remember this very well because I paid a lot of attention to it. President Trump at the time, he made this big push that we need to take interest rates to zero. Now, can you explain why the president would want to do that?
Well, presidents typically do want the economy humming along as strong as possible for purposes of making themselves look good for political purposes, including re-election. Mm-hmm. So that's all good and understandable. You could also argue that any smart representative of the people want sufficiently low interest rates that the economy operates correctly. Central banks in general, in modern economies, to the extent to which they work well, pride themselves on their independence from political figures.
Mm-hmm.
And the reason for that is that politicians are notorious for putting pressure on their central banks to create as much money as possible, keep interest rates as low as possible, hoping that inflation won't hit anytime soon, and I will look fantastic. I'll look like a provider until and unless the inflation does hit. And of course, history is replete with politicians who really don't understand the link between providing money and inflation. So there are any number of examples throughout history of central banks that have not been sufficiently independent from their political figures and who have succumbed to political pressure, sometimes directly. There are plenty of examples of central banks that are absolutely directly controlled by their treasury departments. They're, virtually one and the same, and have issued money that has led to an undermining of the value of their currency in a much more bold fashion than what we're used to. We complain, right, and correctly so, about the inflation that we have in the United States, whether it's 2% or 12%. We like numbers like zero, right? But there are plenty of historical examples where 12% will look pretty good for some folks. And so we always need to be careful about political pressure brought to bear on any central bank, including the Fed.
So you brought up specifically interest rates in regards to the federal government. Now, interest rates on what? That I assume that is the federal debt that the federal government owes.
That's a big one, but markets being what they are, interest rates tend to move together with relatively predictable differences among the markets. So the lowest interest rates we have in the United States are for the best credits, of course, and those include commercial banks and the federal government. Mm-hmm. So at the short end, you might have 30-day treasury bills that trade at a relatively low interest rate and a little bit higher interest rate, possibly for a 10-year, 25-year bond. And then interest rates for commercial organizations are going to trade at rates that are a little bit higher than that. Even a federal agency will pay 0.25%, 25 basis points more than the Treasury Department will pay for borrowing. And then AAA corporate bonds will trade at 25 basis points more than that, unless they're not the best credits, in which case it might be 100, 200, 300, 400 basis points more than what a federal agency would borrow at. So it's all over the place.
So under this system, the federal government, with its prime credit rating, gets substantially lower interest rates than any other entity, simply because of their connection to the Federal Reserve, or
because the people who are lending them the money trust them to pay it back.
Yes.
Yeah. And indirectly, because the Fed, the Fed is one of the reasons why the federal government is able to issue so much money, borrow so much money, issue so many securities, because the Fed is there buying them, right? Mm-hmm. The Fed is not most of that market, but it's a significant piece of it. And so it's very nice to have that in your back pocket. But the biggest reason that they borrow so cheaply is because everybody trusts the U.S. federal government to be able to service its debt. And up until now, of course, that's been a terrific bet, right?
Yes.
We do worry that at some point, I personally worry. I don't mean, knuckleheads worry. I mean, I think we should all be a little bit worried that at the pace we're going, there are reasons to believe that certainly at this pace, we're not going to make it out of this century without the federal government of the United States going bankrupt. I worry about getting into trouble even in the next generation. with the debt now being the equivalent of over 100% of our gross domestic product. That's not necessarily a magic number, but it's an easy benchmark to remember. We have a tremendous amount of debt on the books. And that means that an increasing proportion of what the federal government collects in taxes that they steal from us has to be dedicated to servicing that debt. Yeah. And at the moment, because the Fed has kept rates relatively low, that debt service is manageable. But you worry about the federal government, A, borrowing more, and B, having to pay a higher interest rate as markets change over time. You worry about the Treasury Department getting into trouble potentially. And to be honest, even if the Treasury Department never gets into trouble in terms of being able to pay money back, our economy can get into trouble because of all the things the Treasury, the federal government, would do to avoid a bankruptcy.
Yeah.
They would tax us like crazy to service that debt, and that money would not be going to anything productive.
So I mean, I could foresee a scenario because there's a substantial feedback loop here. I mean, the federal government is charged interest for the debt they hold. The Federal Reserve holds a lot of that debt, and they need a certain amount of money annually to pay that. At the same time, they have inflation that is stifling the economy, killing jobs, and they have to do it in order to keep the money supply, raise rates to keep the money supply in check. So if they raise interest rates, they are raising the payments that the federal government has to pay on their debt. And in order to pay that, the federal government has to tax the people in an economy that is going into a tremendous downslide.
Bingo.
Yes.
So that's the situation we find ourselves in. And of course, this is the big reason why it's so important for the Fed not to allow inflation to take place in the first place, because to stop it, in addition to all the reasons why inflation is bad for us, and we can talk about those, but in order to stop that, you have to reduce the growth rate and possibly the absolute figure of money stock. We can talk about the definitions of money stock, but the stock of money in the world, it's the American money is used all over the world. Of course, it's not just in the United States, but the stock of American money is a number that has gone up fairly dramatically over the past few years because of the Fed's policy. And as we were mentioning, with the Fed funds rate being at zero and the Fed experimenting with quantitative easing, which is to say going into the market and buying trillions of dollars worth of securities without knowing exactly how this is going to go. And the first round didn't blow up on us, but it looks like the second round is. The first round was, as you correctly pointed out, during the Great Recession, the Fed went in and bought trillions and trillions of dollars worth of securities, mostly treasuries, but a lot of federal agency paper as well. The stock of money in the United States went up very, very rapidly, and we were all very, very concerned about inflation. But the Fed being, the world's most apolitical organization, right, felt that it was necessary to avoid the Great Recession turning into a Great Depression. One might argue that round or square, but be that as it may, notwithstanding the relatively slow growth we had during the Obama years, the good news is that we didn't get the inflation that, frankly, I had anticipated. And there's a lot of reasons for that. But that having happened, now the Fed is going back into this experimental phase a couple of years ago during COVID, buying even more, lionized by the earlier experience during the Great Recession. Hey, that worked out okay. Let's take another bite of that apple. So now, at an even faster pace, buying trillions of dollars worth of treasury and agency securities, increasing the money supply by trillions and trillions of dollars. And of course, now we see the inflation that's a result of that. And I'll acknowledge that inflation is the result of that and a whole bunch of other things. But that's one of the reasons why inflation is so bad. It's because it's very difficult to disentangle all the various reasons that cause price increases, and it destroys the information that we get from the pricing mechanism.
So you kind of just answered the question I was about to ask. What is inflation? Let's say that pretty clearly for the audience here.
Well, the most narrow definition of inflation is that prices inflate. Okay, so prices come up. When prices come up all across the board, all over our economy, just the general price level, right? There are various ways that that's calculated, whether it's a basket of goods or the average price at which various goods trade. But there are a variety of ways that economists, mostly the federal government, calculates the overall price level. Prices come up, we call that inflation. And in the main, we recognize that is a supply and demand function. There's just too great a supply of money relative to the demand for money, which is to say the rate at which people need money to conduct transactions in the economy. So if you're laying a lot of money out there, you're increasing money supply, but the demand isn't there to meet it, right? That's when you get inflation. There's just too much money out there chasing a certain number of transactions, a certain amount of goods. So that's where inflation comes from, is too much money out there. It can also come from a variety of other things, which is sort of the boat we're in now. In addition to having bad monetary policy, we've also had, bad fiscal policy, which is sort of the other side of the same naughty coin, which is that the federal government's been spending too much as well. And unlike past times when the federal government has been spending too much, lately when we say the federal government's spending too much, it's trillions of dollars.
Yes.
We could, sure, we were upset in the 80s and 90s when we thought the government was spending too much, but it was $1 billion here and $1 billion there. Now, when the federal government spends too much, it's by so much that it rivals the bad policy of the Fed itself. Trillions of dollars poured into the system. So that's another contributing factor.
In 2020, $7 trillion in 1 year. Kind of to take us back, one of the viewers asked the question here: don't bank loans and credit card purchases also create dollars?
Absolutely. And they're part of that cycle. When the deposit gets made at the bank lends it out. That money is now in the hands of somebody else. They deposit it in their bank. Their bank then lends out most of that to somebody else. That somebody else deposits in their bank. Their bank lends it out.
Yep.
So you see where this goes.
Yeah.
So that is the cycle that accelerates the creation of money supply when a deposit is made. And if you're not careful about how that cycle can take off, you'll get too much, to the comment that's in your window right now, too much money supply. And that's where inflation comes from. And what I was about to say is that there are other things that can cause inflation. For example, today we have bad energy policy to go with our bad monetary policy. And that's a multi-pronged beast itself, right? Not only do we have an administration that was anti-carbon fuels for a long time leading up to the Russian-Ukraine conflict, but in reaction to the Russian invasion of Ukraine, we did whatever we could to make it difficult for our citizens to acquire oil, driving up the price of energy in this country. And that's a big contributing factor. And having said that, I shouldn't pick on only the Biden administration. Plenty of administrations before this one have been dumb, to pick a word. We haven't had real free trade sought after by an administration since Reagan. And I would argue that Reagan didn't do all that great a job of it. But, when we put tariffs on products coming into this country from China, for example, in the Trump administration, that drives up prices for a whole lot of things. We don't typically refer to that as inflation because it doesn't affect the entire economy. But there are some tariffs that can be so broad, energy is one of them. There are some policies that can be so broad that they do drive up the overall across the board inflation rate.
So taking this another step back, taking this back kind of to what we were discussing with the fractional reserve system, would you describe this system as a debt-based currency? And really, what are the implications of that broadly?
Yeah, well, sure. Most money supply in any nation is going to be created by the extension of debt. But to your point, any fiat currency is going to be by definition created by debt, right? It certainly isn't created out of the assets held by the government. We haven't had a gold-based or anything else-based currency since the Nixon administration. And there are reasons why we had to give up on the gold standard. But to your point, the issuance of currency is not linked to anything except this notion of how much money the Federal Reserve believes ought to be in the system to accommodate our demand for transactions based on the velocity of those transactions and based on the size of our economy. So yes, it is a debt-based system, as all modern systems are. And one of the reasons why it's so hard to control, so hard to put that genie back in the bottle, is because you want the value of your currency to float against the value of other currencies. We don't want our currencies to be pegged to something, least of all each other, because we need to be able to have certain currencies devalue relative to each other in order to get out of recession from time to time. So that's a tough nut to crack.
Yes. And to that point, I'd just like to point out that when you have a credit card or you take a loan from a bank, that's listed as an asset for them. And they use that asset to draw down more money from the Federal Reserve, don't they?
Well, sure. I mean, it expands their balance sheet. They have given you the money. So that's brought down their amount of money on hand.
Yes.
They can book the, your credit as an asset, but that money has gone someplace else. Presumably you spent the money, you gave it to someone who made a deposit at their bank. So it's coming out of one and going into another.
Well, they list the asset as the expected interest that you are to pay over the lifetime of that loan or of that piece of credit.
That's exactly right. Just like any other bank loan. That's exactly right.
Yes. So they use that in turn to get more money. So it's all the student loan debt, the debt on the car, the debt on your house, your credit cards. It all goes into this nefarious system to grow the money supply, grow the power of the central banks over the people. And it's effectively debt enslavement, isn't it?
Well, it is certainly a debt burden that we have abused in this country for a variety of reasons, well beyond our wealth, right? Yes. We have got a debt culture problem. And we all need to worry about that. We worried about the position of various financial institutions running into 2007 because they were so highly leveraged. You could see the balance sheets of financial institutions carrying assets that had characteristics that we were not familiar with. These were highly leveraged institutions carrying assets that included home mortgages that were very extended, had much weaker ratios than in decades past, to customers who we weren't used to lending to in decades in the past. Nobody knew exactly how those assets would behave. And so when the housing price bubble burst, it was absolutely a nightmare for those balance sheets on those financial institutions. We should be worried similarly about the household balance sheet, I believe. We have so many households so far extended, not only with mortgage loans, but credit cards, as you mentioned, student loans. And when you wrap that all up, it's not obvious what would happen to the American family if we went into a depression that really lasted a significant period of time and was truly deep, whether it would become a downward spiral because of so many families who would fail on their credit.
Yep.
And that could have a potential domino effect on the financial institution that held those assets, to your point. I shy away from using the word enslavement because I know that can mean things that are a lot worse than owing somebody money.
Yes.
But yeah, it's a real flaw in our cultural character, and I worry about how that will play out in the future. Right. I also worry about the cultural aspect of politicians making noise like it's not your fault that you have student loans, right? Mm-hmm. And that in some sense, the rest of society owes you an easy way out. I worry about the cultural effects of that over the long run.
Yes, it all goes back to easy money because, when your interest rates are artificially low, it changes the calculus on, hey, maybe this debt is more manageable than it actually is. And so yes, that's why it's so important to talk about when we have our federal funds rate, that affects all the interest rates down to all the consumers as well.
That's right.
So when it's artificially low, it's not only incentivizes your government to take on more debts, it incentivizes individuals to take
everybody
on more debt.
That's exactly right. And that's one of the mechanisms that drives an economic expansion. And the reason why the Fed conducts monetary policy, the idea is that they can put out extra money, lower interest rates, and goose economic expansion. That is the theory.
Yes. So moving on from this, what's the connection of the Federal Reserve to Wall Street?
Well, a couple of connections. One, of course, is just keeping interest rates low. Typically benefits those institutions who are in the business of raising cheap money and lending it out with either expertise or other value added in order to make a profit. So that's step one, and we have covered that quite a bit. But remember also that the Fed has a significant regulatory function, which is separate and apart from monetary policy. They grew up out of each other. Remember that the reason the Fed was created was to require reserves to be held. And so the Fed naturally had this function of keeping an eye on banks who were members of the Fed, commercial banks that were members of the Federal Reserve System. So the Fed is in the business of regulating banks and functioning as a lender of last resort. And being the lender of last resort means the occasional bailout, depending on your definition of bailout, that can be quite frequent. And as a regulator for institutions that don't need to be bailed out at the moment, but the Fed is the regulator of many thousands of financial institutions.
Yes.
And can act as a lender, not only to commercial banks, but to securities firms, including making bailouts to securities firms that get into trouble, as they did in 2008-9. So they play a big role on Wall Street, not only in the transactions, but as a backstop. When you look back at 2007, we were all concerned about, well, for the decade leading up to 2007, we were all concerned about Fannie Mae and Freddie Mac. The fact that these were gigantic trillion-dollar institutions that were guaranteeing trillions of dollars of mortgage-backed securities and did not have the capital to back them up. They claimed openly, the Fannie Mae and Freddie Mac, that they did not have the backing of the federal government. And the reason they claimed that was to avoid regulation by the government. They did not want the Fed to require them to have significant capital on hand because capital is expensive and would slow down their business. So they went around telling politicians and the American populace that they were not backed by the federal government. But lucky for them, nobody in financial markets actually believed them. On Wall Street, everybody knew damned well that if the crap hit the fan, Fannie Mae and Freddie Mac would be made good by the Fed or some combination of the Fed and the Treasury Department. And when that happened, mortgage-backed securities were purchased by the Fed for the first time in 2008, and then in large quantities. And these institutions were kept afloat. And even to this day, they have better capital than they used to. But even to this day, they do not have anywhere near the capital that they ought to. So that's just one little story that illustrates the fact that, having the Fed as a big brother is a very good thing. It makes your business a lot cheaper to conduct because it's a lot cheaper to have a big brother backing you up than to have the capital that you need on your own.
Yes. Correct me if I'm wrong. Both Fannie Mae and Freddie Mac were created by the federal government, weren't they?
Absolutely. They operate pursuant to federal charters. Of course, they claim to be private sector organizations. We can argue about whether, what the definition is of a private sector organization. They have private market, shareholders. Their stock is traded on the various stock exchanges around the world, sure. But their board is in part appointed by the President of the United States and cleared. Let me point out one example. When I was in Washington, the head of Fannie Mae, the chief executive officer, was a professional lobbyist. Now, you might wonder, what's the background of most giant financial institutions? It's typically a banker who grew up in that organization or some other organization. If you have a financial institution, the head of which is a professional lobbyist, you see where I'm going.
Yes. So these institutions, which were created by the federal government, their executive officers are appointed by the president, and they're going around telling people that they are not backed up by the federal government.
They would scream bloody murder that they were not backed up by the government because they wanted to avoid regulation and especially avoid capital requirements.
Interesting. So they are given...
But they were able to raise money
yes,
at something like 20, 30, 40 basis points above treasuries. So if the Treasury Department was borrowing at 3%, they would borrow it at 3.25%, illustrating that nobody believed them when they said they were not backed up by the federal government.
Yes, it's insane.
But because
behavior.
Politicians believe them,
they
didn't have significant capital requirements.
I can't describe that as anything other than fraudulent.
Well, and a lot of people did describe it as fraudulent. I mean, I would agree with you, but just because you and I agree doesn't mean anyone else is listening.
Yeah, I just think that's insane.
There's a difference between fraudulent and insane. Remember, they made a boatload of money.
Yes, absolutely. So, going back to this relationship of the Fed and Wall Street, can you just describe? Let me wind back a minute. I remember in late 2019, the Fed announced that they were increasing their overnight lending operations to Wall Street to, I think it was like 1.25 billion a day at first. What is this overnight lending system? What does it do exactly?
No, most of that is just their business of buying treasury securities.
Okay.
In the main. Now, they do conduct a number of other types of transactions with securities firms, and they're much tighter with securities firms than they ever used to be.
Mm-hmm.
It used to be the securities firms and commercial banks were completely separate and weren't allowed to be under the same umbrella, and most of that has gone away by now. So frequently these types of transactions are in the same financial institution. But the Fed does conduct multi-billion-dollar transactions with securities firms every day in terms of buying and selling securities, mostly treasuries, but also agency paper, and in many cases, other kinds of paper. And that's part of what you're getting at. The Fed is allowed to participate in commercial paper markets, buying short-term paper issued by a variety of financial institutions, and making sure that markets stay liquid. And this comes up in a big way when a financial institution gets into trouble.
So I brought this up because of its relation to Wall Street. So the increase from, I think before 2019, it was something like 500 million a day in these operations, and late in 2019 like I said, they increased it to above 1 billion a day.
Yeah,
in essence, these are open market operations that gives easy
but
money
huge
to huge operations that give easy money to Wall Street on a daily basis.
Yeah, that's how they're conducting monetary policy these days, because they cannot so easily control the Fed funds market the way they used to. With the Fed funds rate down to zero, and indeed with Federal Reserve requirements, reserve ratio requirements being down to zero for most types of deposits, all small deposits, it's not as easy to conduct monetary policy as it used to be. And so the Fed finds it necessary to go in and buy huge volumes of securities from the primary securities dealers through the Federal Reserve Bank of New York in the basic markets in New York City. Huge volumes.
Yeah.
And the problem, of course, is that such transactions, the effect of such transactions, are very difficult to predict. They did have experience in the Great Recession that did not blow up into a large amount of inflation. And they believe that they can conduct even more of that today without getting to inflation. But that's what obviously has blown up on us over the past year, right? And very difficult to sort out. Indeed, there's no perfect way of telling, is the inflation that we see today, of all the factors that play into that, too much federal spending, supply chain interruptions, bad energy policy, bad monetary policy recently, difficulty controlling monetary policy because of the Fed funds market being without reserve requirements and being down to zero in the Fed funds rate. Those are two different issues. Or bad monetary policy during the Great Recession. There's no real good way of teasing out how much of the inflation we see is due to those various factors. We can make educated guesses, but I would submit that when even your most nerdly economists in, brilliant teams of humans can only make educated guesses about what has gone wrong, this is a market that we probably shouldn't be in the way that we're in it.
Yeah.
The amount that's at stake is huge, huge. not only is inflation very detrimental to the way the economy works, because the way the economy works is to read prices. And if you're screwing up all the prices, things just don't work that well in terms of efficiency. But because various markets are affected at different rates, for example, we see asset bubbles created when we have a lot of inflation, but labor market prices, wage rates, don't come up as fast. So because you see markets affected at different rates, you've got these disparities in how different types of people are affected. I'm not a big class on class guy talking about, Marxism, but you got to be a doofus not to be sensitive to the notion that during an inflationary period, if you're not heavy into stocks and you're just a wage earner, you're getting hammered.
Yeah.
That can't be a good thing. In addition to that, you've got the federal government reacting to it, right? And
yes.
One of the things that you have to be humored, and this is not a real humorful topic, but one of the things that you've got to note is the irony of the Fed feeling like it's got to clamp down and probably sending us into a recession, quite possibly a recession that we're already in. We should probably talk about that.
Yes.
The Fed feeling like it needs to clamp down and possibly send us into a recession. And the administration talking about, well, maybe we need to put out more money to help people, to accommodate people's needs for more money during these trying times.
Yeah. It's insane that they keep repeating the same exact mistakes that got us into this situation. Now, one last point.
They can't help it.
Yes.
It's this, the turtle and the scorpion, right? I mean, this is what I do.
Yes, I just want to hit on two things. Going back, one last point about this overnight lending thing is this is all $1 billion a day going into Wall Street to buy and sell stocks and bonds and treasuries on a daily basis.
Good business if you can get it.
Pardon? Good
business if you can get it.
Yes. And they profit off of each and every single one of those transactions.
Absolutely.
They got a cash infusion every single day for years.
Yeah.
And
the most important of which is what you just put your finger on, the transaction fees. But keep going. I like the path you're on.
Imagine you see this bubble on Wall Street going up and people can't afford to buy food and gas anymore. It's a huge wealth redistribution scheme.
It's enough to make you a Marxist, isn't it, Connor?
Oh, they'll turn you into an anarcho-capitalist here if we're lucky. So, moving on from that.
Agreed. I don't know if you wanted to comment on that. I mean, yes, agreed. And, we do want our financial markets to work. We want them to work efficiently. We want them to work smoothly. And I recognize that there are billions of transactions and trillions of dollars at stake. I'm not suggesting that this needs an overlay of regulation. Where I think you and I are going is that less intervention by the federal government, whether in the name of a central bank or the Treasury Department, less intervention from the federal government is something that we could live with.
Yes. So to one of the points you just made, all these powerful people in charge of the Federal Reserve, your Janet Yellen in the Treasury, Jerome Powell, and all the other eggheads that the federal government appoints to these positions, they clearly don't even really understand the situation they are in clearly, right? Is that kind of what you were getting at?
Yes. Best efforts notwithstanding, I'm not a big fan of suggesting that these people are evil or in some sort of a conspiracy. For the most part, they are doing the best job they can inside the framework as they understand it. They truly believe that the world is made better by big dramatic bets made by our central bank.
Yes.
I believe they are wrong about that. But they do believe that they can smooth out recessions by making these huge money plays. And because they've gotten themselves in a situation in which it's increasingly difficult to pull that off, they may have to make huger money plays every time they do it.
So we're ending up into a point where it's just a feedback loop. In order to do anything, we just need to gamble bigger, bigger, and bigger every single time. And it's bringing us to lower and lower lows for the average person. So
I think that that's right. And I think that that's why we need to replace the monetary policy that we have. You and I had talked about this briefly earlier. We need to replace it with a rules-based system instead of giving all of this discretion to a handful of individuals. And I think that your basic two options, I would view one as a stepping stone on the way to the other. One is to give it back to the commercial banks and end the notion of having a central bank altogether. Or I should say, getting rid of central banking altogether. Mm-hmm. And the other, which I would view as a stepping stone toward that, is to simply replace the discretion that the Fed has with a rules-based system that says we're going to target money supply and increase it by a fixed rate every year. Whether it's 2%, 3%, or 4% doesn't matter as much as absolutely being marrying to some number. Mm-hmm. And for money supply to be targeted, the Federal Reserve Bank in New York or any other big financial institution could be used to conduct the transactions to try to make that happen, and just replace monetary policy with a laptop.
Okay, so we've talked about a lot of the problems with the system. So let's explore solutions more. You have a plan, don't you?
My plan would be, as I said, to replace it. I do, thank you. And insultingly, as an insult to the Fed, right? I put together a video that's all like 2.5 minutes. So if any of Fed economists were to look at that, they'd be like, "Oh my God, this guy thinks that we're so stupid to replace the whole thing in 2.5 minutes." I don't mean that at all. It's just I could outline what to do about it in 2.5 minutes, right? The real challenge is the politics of it, not merely the details of it. But the basic idea is you got to take away the discretion of the Fed and replace that with some fixed rule. And then you need to replace the regulatory framework that the Fed has and replace that with commercial banks being given options as far as their regulatory structure. Even today, banks can typically choose, by virtue of what type of charter they have, who is their regulator. But I would add to that, banks absolutely need an option of no regulator whatsoever. I'm doubtful that too many commercial banks would jump into the zero regulator idea right away, because, of course, they feel like they need a good housekeeping seal of approval. But you could certainly imagine someone opting to have no regulation, but hiring, their accounting firm to do a more robust annual report than they do now, as something in lieu of, federal government or state government regulation. You could absolutely imagine that. And, as far as the Federal Reserve banks go, the 12 regional banks, a lot of them, and they are private sector owned. They exist pursuant to a federally issued charter, of course, but they're private sector owned. I would spin those off and tell them they're private organizations. They provide a lot of services. They settle check transactions and other payment services to their commercial bank customers. If their commercial banks want them to regulate or audit them, that's a way that they can continue to conduct business. And those that aren't adding enough value can go by the wayside and go bankrupt or merge or whatever is their best exit ramp. And of course, I would take the Fed balance sheet and I would transfer it on budget. In other words, I would take that $9 trillion, fold it right back into the Treasury Department and tell them, you can't spend money without federal legislation. There's no great silver bullet to stop a bank bailout or to stop the bailout of any other, to stop a bailout of Chrysler or General Motors or Ford, right? We've learned these things the hard way. But at the very least, we can make it harder. One of the reasons we have the bailouts that we've had in the past is because it's so easy for the Fed. I mean, if you got a balance sheet of $9 trillion and can create money with a magic wand, it's not hard to bail out a securities firm or a commercial bank. And if you're their regulator, it's not hard to make a phone call to Wells Fargo and explain to them that they're going to take over this crappy commercial bank that you're worried about in Atlanta. I'm trying not to name names. And you're going to do it by Friday as a personal favor to the Fed. Those are conversations that I appreciate, as I'm sure having been well-intentioned, but we simply cannot do business that way in a country that depends on free markets for economic growth and for efficiency. So 100 years ago, I used to spend a lot of time, I used to work with the American Bankers Association. And one of the things that I found interesting is that this was a very much free market organization. We were dead set against bank bailouts, and we were representing the banks themselves. How's that for weird? Because the banks, the banks didn't want to be seen as someone who would potentially need a bailout. So we spent a lot of time coming up with ways that a bank can certify that it's ready to go bankrupt, what we used to call a living will. So that if a bank got into trouble, there would be ways to dispose of the assets without the Fed bailing them out. That's the kind of thing that we need to rely on. We need to rely on market mechanisms, private sector mechanisms to resolve institutions that they get in trouble and get away from these bailouts.
So the ultimate solution then is to end the Federal Reserve System.
I truly believe that. And I think look, we all tolerate half measures when we have to, yes. Right? So even though I say you got to end the Fed, and I would love to do it by Friday, if we were to just do any one of those things, I'd be happy about it. Even if you could imagine, even if the Fed continued to exist and you took away their monetary policy discretion and replaced it with a rule. No, it's not everything we want. That'd be a hell of a lot better than the swings and money stock that we have today, right?
Right. So now a lot of we've been making a point at LP National to talk a lot about ending the Fed. Now, what's the actual roadmap to doing that?
I think the roadmap is probably without a crystal ball, right? Yeah. I think the roadmap is probably take away.
If I could interrupt for a second,
please. Let's
make some assumptions here. Let's assume we actually had the ability to enact this roadmap. Let's take that as an assumption, and our other principles in like free markets are enacted as well. Let's take that as an assumption.
What you want to do is take away the Fed's discretion in terms of monetary policy, so that people can get used to the idea of not having an all-powerful set of 12 people that we trust with setting the course of money stock. Because until and unless politicians get comfortable with that idea, you're not going to be able to take the next step. Does that make sense?
Yes, it does.
Because I think for a lot of people, getting rid of the central bank altogether feels like flying without a net.
Right. And
I can appreciate
understandable
that.
To an extent.
I think it is understandable, particularly when you look around at all the other systems of governance we had and you notice how much is driven by fear. I spent a dozen years in the criminal justice system. I can tell you that most of our state legislatures are driven by fear of things that they probably don't need to be so fearful of, right?
Right.
And we don't need to contribute to that. But I think people would get comfortable if they could see that a rules-based system for monetary policy would be a very good idea. And after a certain period of time with that, you could see where you'd be able to do without the Federal Reserve Board itself. Now, the regulatory function is an important one. But like I say, if you gave commercial banks the option of getting out, you could see where you could live without it. For example, as another example, which is unrelated, one of the things that bothers libertarians like you and I, Connor, is for example, entitlement, like Social Security.
Yes.
Right. Mm-hmm. And we would like to live in a world where we don't have a program like this, where the federal government mandates this and that, yada, yada, yada. Right.
Yes.
But if you were to shoot it on a Thursday night, you can imagine how much fear that would cause. And I think the stepping stone to getting rid of it is to give people an opt-out, an exit ramp from the system. So you shrink it until then one Thursday night you can shoot it.
Right.
And I think the same thing with the Fed. You give commercial banks the option to be regulated by someone else or by nobody at all. And you see where the rest of the Federal Reserve Board functionality is in effect gone. And then you pass legislation that says, we can't be bailing out people. Now, having said that, I realize I didn't say that in a very sophisticated way, but it's partly because you and I both realize that there's no such thing as legislation that can't be overridden by future legislation.
Yes.
Again, there's no such thing as a silver bullet in this regard.
No, there is not.
But if you had legislation that took away the Fed's monetary policy discretion, that gave commercial banks the option of getting out from underneath Fed regulation, and you took away their balance sheet, and you took away their discretion for bailing out institutions, functionally, they're gone. Then, like I say, on a Thursday night, you can just shoot it, and nobody would miss it. But I do think that that's a fairly long process. And by the way, that is how so many things go in terms of federal legislation. People learn to work around it, and then you figure out that the law really doesn't have the teeth that it used to, and now it's just a pain in the ass, and then you shoot it.
Yeah.
And that's what we need to do, I believe, with the Fed. And then we can start our own libertarian food fight argument about what the right thing to do with our currency is. Is it to turn it back completely to commercial banks? Do you want to tie it to something? Like I said earlier, I do believe it needs to be tied to something. I believe that the right way to go is to target a growth rate and money supply, as opposed to targeting an interest rate, as opposed to targeting a price. But we can have that argument.
Well, let's have a brief discussion about that, because libertarians and Austrian economic leaning people in particular, we are not prescriptive. It is not a prescriptive philosophy.
Agreed.
Like the study of Austrian economics is descriptive. It talks about the world.
It's one of skepticism.
Yes, it describes the world as it is. It describes how people work and function. So when we libertarians are good at identifying problems, and we're good at recognizing wrongful acts of aggression and coercion in particular. But we don't necessarily have one-size-fits-all solutions in freedom, and so we don't have the temerity to say something like, this is how we do it, this is how we have to do it, this is the only solution. No, we believe,
with the possible exception of that we probably if I can make this assertion, you can push back on me,
Sure.
is that we all pretty much agree that less government intervention, the better.
Yeah, absolutely.
And typically, without a pain in the ass financial institution like a central bank in the way, surely financial markets would work better in the long run.
Yes. So getting to the solution of...
So I'm going to suggest that's the end goal.
Yes. Yes, the end goal is that freedom. So, but when we are in freedom, is people, consumers, individuals, they'll have options. They'll have choices because we have a market system.
Yes.
And the system...
Including in money.
Yes. The system that meets the most people's needs will be the one that rises to the top.
Agreed.
And no individual or no group of people, especially not a government, is smart enough to determine exactly what that is.
Agreed.
So we're agnostic on what the solution is. Like for this last month, we've been doing a fundraiser with the help of the Bitcoin community. We're big fans of Bitcoin because of its decentralized and free market nature. But a lot of people have reasons.
And I've gotten burned on the price. I'll admit that. I've had bad moments, but I'm still a fan. Yes. I'm still hanging on.
It's certainly not perfect, and people have reasons to be skeptical. But
of course,
there's still gold, there's still silver, there's still Ethereum, and there's still all kinds of systems that we don't even fully know about yet, that some entrepreneur will introduce to service the needs of the masses.
I believe, Connor, that in 400 years, someone will look back on the conversation you and I are having and they will giggle.
Yeah, and they'll probably think, oh, it took them another 300 years to figure it out, or for the rest of the world to figure it out. But
well, that may be. And one of the things that concerns me is that we do want free market competition among currencies.
Yes.
One of the things that concerns me is that the U.S. currency has been winning that for a long, long time, which is great, which is fine. Mm-hmm. But we have won it by so much. We have not enough incentive to make it better.
Right.
We don't have a really good competitor on the horizon. When people talk about, we've screwed up our currency so bad we're going to get replaced. Really, by what? Now, we're all optimistic that there will be an emergent facility to rival the dollar. I remain optimistic. Not in my lifetime, maybe in yours.
Hopefully.
Hopefully, right?
Yes.
And these things can go relatively quickly. I mean, it could be in my lifetime. But whether it is or not, it does not look like, as dumb as we can be, as bad as our central banking system can be, it does not look like we're likely to be characterized as dumber than any others anytime soon. If you look around the world at the other currencies, man, I'm not exactly. Yeah. Look out that window and let me know what you see. I'm not optimistic about any, the euro? No. Oh. I'm sorry.
Yeah, the euro's been at negative interest rates for a long time.
No, and I'm sorry. The pound? No. The pound, I would be more optimistic about the pound than any other nation-issued, central bank-issued currency.
Well, I'm glad that you brought this, that we're going down this track, because I wanted to bring up that obviously with the war in Ukraine, the United States and our European allies have leveraged a lot of sanctions on Russia and the ruble. One of their responses to that was to convert their ruble to a gold-based system.
Yeah.
And of course, they fled the dollar-based SWIFT system, international payment system, and they joined the Chinese CHIPS system.
Right.
And of course, in the same subject, what a lot of people don't appreciate is, and it's kind of flown under the radar for a long time, is that the Chinese government is probably has the largest gold reserves in the world.
I believe that's true. Yes.
So we do have competition in that regard.
The question is whether it's biggest by far or by a little.
That's true. Some of the I couldn't tell you the exact figures, but some of the I remember reading something just a couple months ago that suggested it was by a lot, but I couldn't quote you exact figures.
Very few numbers that come out of the Chinese government can be trusted on face value.
Oh, that's true. Though it's there are a lot of estimates, but it's we don't have to get into the particulars.
No.
But it's there is a rivalry, but I really think that when you factor in the size of Russia's economy, and then you factor in the fact that China is taking on debt at a greater rate than the United States is, even with those real asset-based currencies or commodity-based currencies, I should say, they are still tremendously risky.
Yes. I like where you're going. Keep going.
So it's I'm just pointing out that, as you said, the solution of what is a real rival to the dollar out there isn't really as cut and dry as it may appear.
No, I wouldn't. I wouldn't bet on China with your money, Connor.
No.
I truly believe that is an economy that is going to be, it arguably is in trouble right now.
Yes.
But will be visibly, noticeably, publicly so relatively soon. And at my age, I count relatively soon as the next 10 years.
Right.
I would not bet on them at all. I would not bet on the Japanese economy. Nope. The Russian economy is hardly worth a conversation. But I do worry. I worry about the Chinese economy, not because of some weird affinity, but I worry about what they do in reaction to that.
Yes.
When economies go bad and aspirations are dashed, politicians do some weird shit. And so I worry about that a lot, because they'll still be large and powerful and interested in becoming like the United States. And there are a lot of things that we are that I don't want China to become like. I want us to be a lot less like we've been. Not China to become a lot more like we've been, right?
Yes.
So, for all the bad decisions that we have made as far as military interventionism, imagine if China gets the bee in their bonnet that they want to be like us. Yeah, just let that sink in. That's a scary proposition.
It is a very scary thought.
It's a very scary thought, particularly because of the sizes of other militaries around the world that may not like where that is going, like Saudi Arabia. But to your point, we do want rival currencies. I don't see them coming out of central banks anywhere around. I am fascinated by Bitcoin, and I really want to see how it plays out. And I wouldn't even say we're to the point yet where it's appropriate to characterize ourselves as either pessimistic or optimistic. We're not even to that point yet.
No.
We're at the point where we're just watching.
Yeah.
Right. I mean,
trying to hold on to our butts in the sinking economy.
When you watch the beginning of a marathon race, do you look at how the performers have done over the first 5 miles and say, I'm optimistic or pessimistic about this guy or that gal? Or no, I mean, you're not seeing anything yet that's all that relevant. And I think that's where we are with Bitcoin and the other, what I would characterize as emergent currencies. So I want to see how that plays out. One of the things that you and I didn't touch on is that I am also afraid that if the Fed is not sunset soon, I'm afraid that they'll get their back up in defense of the dollar in terms of regulatory structure that they try to burden a Bitcoin with, for example, and undermine the development of that market. And I think that would be a real shame. So that's one of the reasons why there must be members of your audience who are frustrated when we talk about stepping stones and layers of legislative steps that are required to get rid of the Fed because we all want to go faster. This is one of the big reasons why it's important to go as fast as we can, because the Fed is a very politically powerful organization. As much as power as they have to screw up our economy, whether it's through bailouts or bad monetary policy, they are also politically powerful and can defend their position ruthlessly. So I worry about the implications for competitive currencies in that regard.
That's one thing that, on the one hand, it was viewed as a great thing that these big financial institutions on Wall Street were buying up Bitcoin. It was viewed as them accepting cryptocurrency. I thought it was a good thing because, of course, the value of my Bitcoin went up with it. But it's scary that these big financial institutions that, as we discussed earlier, are getting billions of dollars a day from the Federal Reserve and, of course, are making a killing off of a tanking economy, scooping up something as powerful a tool as Bitcoin. Obviously, they aren't able to capture the market because the market for Bitcoin was at its peak like worth $1 trillion. And frankly, there aren't that many institutions that can swing that. But they were scooping up
serious amounts of money.
Yes. Scary amounts of Bitcoin for a while, which that's not an indictment of Bitcoin itself, but it points out the insidious nature and powerful nature of these institutions.
Well, it does. And imagine if they got it in their head that they had a certain mood. And as you know, American financial institutions, for that matter, international financial institutions, but especially American financial institutions, move as a herd. So you can imagine markets moving one way or another just because New York had a bee in its bonnet. The other problem I have is that all of these institutions are subject to federal regulation of one sort or another, largely affected by the Fed. So if the Fed, as we were discussing just a moment ago, if the Fed wanted to undermine the development of the Bitcoin market, one thing it could do is not recognize and it's doing this, it could refuse to recognize holdings of Bitcoin on a financial institution's asset as anything but a speculative investment, as opposed to, some sort of highly liquid investment, thereby requiring a financial institution to carry more capital against it, making it more expensive to hold that investment.
Yes.
So this is very important. Very important.
So, Mike, we've been live for about hour 40 now. I think it's getting time to close.
It doesn't seem like that. It flew by. As a matter of fact, I think you're lying to me. I'm not that good with certain numbers, and one of them is keeping track of time.
Well,
Connor, honestly, I got to hand it to you. You have a tremendous number of really interesting questions. I wasn't sure where you wanted this conversation to go when we got together and said, let's talk about this, but I've really enjoyed talking to you about it. And, I hope that your listeners found some of it of use and some of it interesting, but I got to say, you were a lot more interesting on this topic than I could ever be.
Oh, I appreciate that, Mike. Do you have any closing thoughts for our audience here?
No, just the basics, right? These markets seem opaque because they're intricate and sometimes they're difficult to understand. But the truth of the matter is that the very basics of supply and demand, of deregulation, of avoiding markets being interfered with by the federal government or any other government or financial institutions that operate independently with tremendous power. These are the basics that you would object to in any market, right?
Yes.
And there's no real fundamental reason why these markets should be treated any differently. So we all need to stick to our guns in terms of our principles and don't let eggheads. I love the word that you used in describing Janet Yellen.
Nerds.
I would have said something a lot, and have said something a lot harsher about Janet Yellen, and I do think her heart is in the right place, but she is absolutely a dingleberry in terms of how she understands how the economy works. I've been very disappointed by her comments during the Biden administration.
Mhm.
But to your point, let's not be intimidated, right? Or told, go away, you people don't understand how these sophisticated things work. No, the basic principles that we all believe in of libertarianism and free markets and property rights, and by the way, basic ethics, they apply to these markets just like any other.
Yes, is too often people overthink these things. And when you look at complex systems as a whole, fundamentally, there is a point where they are just that simple. There's a lot that gets in the way, but there really isn't. So thank you for your time, Mike.
Thank you.
You everybody for tuning in and watching. And please don't forget to donate to the Libertarian Party's Declare Your Independence from the Fed. Go to my.lp.org/contribute/independence-moneybomb. So thank you very much, everybody. You have a good night.